This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, let's begin the analysis. And let's begin the analysis by focusing on our performance. So the focus there is upon the statement of profit or loss and other comprehensive income. Which to you or I is effectively just a statement of profit or loss. Other comprehensive income may appear on the odd occasion. So, let's go through and discuss the calculation of the ratios, and then let's look at what causes those ratio balances to move. Okay. So first of all is the margin. So your margin, as you know already, or at least I hope you know from financial accounting and other subjects within your qualification, is that your margin is the profit generated per $1 of sale. So if you have a 10% margin, that means for every dollar of sale, you have generated 10% of the dollar, 10 cents as a profit. However, within our statement of profit or loss, our performance statement, there are several different profits that appear. The first one is your gross margin. So you just take your gross profit divided by revenue and multiply it by 100%. So that's looking at the that is looking at the profit that you make per dollar of sales from just the physical buying of the goods and selling of the goods, or buying the raw materials, subjecting them to a process, and then selling them at the end. Okay. You also have your operating margin, which follows on from your gross margin, doesn't it? But here you take your operating profit, which effectively is taking your gross profit and deducting your expenses such as distribution and administration, and then looking there at the profit that you've generated from the day-to-day operations, encompassing all of the costs that you incur within your business, not just the cost of selling the goods directly. And then at the end, you've got your net margin, or your profit for the year margin. So it takes your figure at the bottom of the statement of profit or loss, so your profit for the year, or your profit after tax, to give it its old name, divide by revenue and multiply by 100%. And effectively what you're looking at there is how has there been the distortion from your profits from operations down to profits for the year. So things that will arise in between will be your finance costs and then your interest. Okay, so what ultimately has happened to those. So let's just go through and look at the gross margin. Use a made up fictitious example to illustrate the point. Imagine your current year is there at 40% and previously it was there at 30%. Okay, so what you can see there is that the margin has improved. Whatever you do, don't say that the reason the margin has gone up is because we've sold more. Okay, if you sell more, you incur more costs in equal proportion. And although your profit's gone up and you've sold more, the margin stays the same. Okay, so you need to break it down into costs and sales per unit, selling price per unit. If the margin's gone up, then your cost per unit must have gone down, or your selling price per unit must have increased. So what could be the reasons behind that? Okay, I'm not expecting you to rote learn them all, but they're just indicators, points that you could potentially bring into the analysis. In the exam, you're usually told. You just need to take what you're told and put it in your answer. It's as simple as that. So cost per unit have gone down. Maybe you've bought some goods in bulk. If you buy in bulk, you get discount. Okay, so bulk purchases is giving you a quantity discount. Maybe you've gone to a new supplier. So you've gone to a new supplier because it's cheaper. Great, improves your margin. Just be careful. If the cheaper goods, there could be a quality issue. Okay, and there could be further issues down the line, reputational damage. But at the moment, based on what we know, new supplier, cheaper costs, better margin. Could be you've got increased purchasing power. So because you're so big and you're so powerful, you can dictate the prices to your supplier. Instead of them telling you what to pay, you tell them what you wish to pay. Because if they don't accept your offer, you'll move elsewhere. And your supplier can't afford to lose you. So you have that increased purchasing power. Could be technology changes have made things more efficient, so therefore that has reduced the cost per unit, maybe of producing the goods. Okay, maybe they can be produced quicker, so you're incurring the same cost, but you're producing more, so there's a reduced cost per unit. Okay, so it's all about improved efficiency. In terms of your selling price per unit, maybe you've just taken account of the fact that there's an increase in demand for your product. It could be the child's toy of the summer, or the child's toy as we head towards Christmas. So you've put the price up because there's a massive demand. Okay. There could be ethical implications behind that. You might be, taking advantage of your consumer, but, from an analysis perspective, take advantage, from a business perspective, take advantage of that increase in demand. Okay. Could be a shortage of supply. So there's a shortage of supply of gas, electricity, water. I always find that quite scary, don't you? A shortage of water happening in South Africa and Cape Town. But if that's the case, that maybe they can put up the price of water. Okay, increase the price per litre. Okay. It could be that you've launched a new product. That new product has a new margin. Okay, so maybe you're a car manufacturer, and what you've decided to do is to launch a brand new higher margin car. Maybe it is there as more fuel efficient. Maybe it is there as a hybrid model. Maybe it is an electric car, so therefore you've got a higher margin product. Okay, so you can sell it at a higher price per unit. Okay. If we move then on to the operating profit margin, the key bit there is that you're looking at what's happened between gross profit and operating profit. So you're looking at the expenses and what's happened to them. So if we carry on with our previous example whereby the gross margin had increased, what about where the margin then for operating profit has gone through and fallen? Okay, what has happened between gross and operating profit? Something must have increased. The cost must have increased for that margin to then go through and fall. So it could be you've got older assets. Older assets need repair. They need maintenance. So therefore, increased maintenance costs will go through there and reduce the operating margin. New premises. So you've got maybe fancy new premises. So there's therefore maybe an increased rental expense within the financial statements. Again, that rental expense reduces the profits. Okay, your operating profit. It wouldn't have impacted your gross margin. Could be that you've launched a new product. If you launch a new product, there's all sorts of advertising, marketing costs that you incur. So yeah, your margin may have increased because it's a higher margin product, but the operating margin is reduced this year because of those launch costs. Okay, so that might improve next year once those launch costs are out of the way. Could be that there's an impairment within an asset. So maybe your head office has fallen in value. So that reduction will go through there, your administrative expenses. Again, that impairment might be one-off. So if you remove it, what actually happens to the margin? And then one that we've seen in recent years in the real world is all about restructuring. Okay, if that's the case, you may have decided to close down a part of your business. Therefore, staff are being made redundant. So therefore, you have a big provision within the financial statements this year, which has therefore reduced your operating profit, which won't have reduced your gross margin, gross profit. It will have gone through there, likely through your administrative expenses. So therefore, a lower operating profit, a lower margin compared to our higher gross profit and gross margin. Okay. So that's just a little bit there about the margins. Okay. Keep an eye out for those within the exam.